Picture an apartment listing in Amsterdam priced at €650,000, while average household income sits at just 52,000. That gap is not accident, it's architecture. In the Netherlands, housing is a system deliberately engineered to keep prices up and buyers locked in. You can feel the pressure in every transaction. But here's what becomes interesting. Supply is growing and interest rates have stabilized, yet prices refuse to fall. What machine keeps them aloft? What mechanism prevents this gap from closing? The answer isn't simple supply and demand dynamics. It's policy, leverage, and constraint working together, each piece reinforcing the others until the whole system becomes immovable. Start with this number. Dutch households carry 94% of GDP in mortgage debt. That's not a statistic. It's structural commitment written into every family's balance sheet. When you owe that much, you don't walk away from price defense, you double down on it. The hypotheekrenteaftrek, the mortgage interest deduction, deducts at approximately 37.56% in 2026, unchanged since 2024. You borrow to buy. The state subsidizes your interest. Your demand stays engineered before you ever see a property listing. Engineered demand doesn't collapse. It calcifies, and once calcified, it only ever pushes upward. Imagine you're a Dutch buyer sitting at the mortgage table, ready to commit. You borrow €400,000 at 5% interest. That's roughly €20,000 per year flowing out of your account. But here's what the tax system does. It returns approximately €7,500 to you annually. The state effectively pays for 1/3 of your debt burden, this through deliberate policy architecture. This isn't fringe, it's the spine of the entire market. Every new buyer enters with this subsidy already baked in. They won't undercut prices. They won't accept less leverage. The math no longer works in their favor. The incentive structure has been inverted. It rewards holding. It punishes selling. Now let's talk about new supply, which is growing but not fast enough to matter. The Netherlands has added roughly 69,000 homes per year in recent years. That sounds like progress until you look at actual household formation. Households are growing faster through immigration, family formation, and lifestyle shifts. The math becomes brutal. 3.4% annual growth in housing demand, while current supply covers less than half. This isn't merely a shortage, it's a structural deficit hardwired into the system. It's climbing toward 410,000 homes that don't exist. Deficits don't heal themselves, they compound. Compounding deficits mean prices stay firm because supply can't catch up. Price becomes the only language demand and supply speak to each other. Why so few completions when every city wants more housing? Because the system resists at every structural joint. Those joints are cemented in place. Zoning rules are strict. Nitrogen emission regulations constrain development sites. Permitting takes years, not months. The government promised parallel planning, simultaneous approvals instead of sequential processing. This theoretically shrinks timelines from 6 years to 2, but 2 years is still a cage compared to what demand requires. The supply constraint isn't laziness or incompetence, it's embedded in regulation, it's embedded in environmental law, it's embedded in how the state defines what can and cannot be built. Those embeddings have weight, they don't move easily. That's precisely why they work to lock the system. Social housing covers 30% of the Dutch stock, Europe's highest ratio. That protective appearance dissolves the moment housing corporations start selling. They sell to investors who buy and hold. Why? Because your country's design incentivizes it relentlessly. Mortgage interest is tax deductible. Capital gains on primary residences are tax-free. A portfolio of rentals compounds quietly. An owner-occupied home compounds openly. Both profit from stillness. Both resist downside pressure. The rental market fragments as investors consolidate. The owner-occupied market thickens as families borrow more. Leverage accumulates across the entire system. Nobody has any incentive to clear excess inventory at lower prices. Not the housing corporation, not the institutional investor, not the household mortgager. Everyone's balance sheet improves when nothing moves. The gap between prices and incomes just keeps widening. The consequence materializes in one brutal metric. The price-to-income ratio sits at 8 to 10 times in the Randstad. That's that concentrated region where most people live and work. What does that number mean in practice? It means buyers under 35 cannot finance homes currently available. They fall short by roughly €120,000 on average. This isn't temporary, not cyclical. This is structural. The system has built a wall deliberately through high leverage, tax incentives, and restricted supply. These three mechanisms don't produce flexibility. They produce rigidity. They produce prices that cannot fall without breaking the system itself. The system is everyone's balance sheet. The wall is everyone's collateral. Prices won't fall. The wall stands because it's load-bearing for the entire structure. Not accident, by design. The Dutch housing shortage is not cyclical, but locked in by policy. Each component makes sense in isolation. Mortgage incentives support ownership. Zoning constraints protect the environment. Tax architecture favours real estate investment. But together they form a trap. Supply grows 69,000 per year. Demand exceeds it by 160,000. Prices rise, leverage deepens, and then you reach the pressure point. When leverage deepens, you need prices to stay high. But if they fall, balance sheets break and default cascades through systemic risk. If prices rise further, affordability collapses for anyone young or poor. The system is caught between two kinds of failure. There's no exit in either direction. That pressure has to go somewhere. Where does it go? Right through the next phase where it becomes somebody else's problem. The government announced a housing summit in 2025, with new zoning reforms and relaxed building codes coming. Faster permitting pathways too. On paper it looks serious and comprehensive. But here's what matters when you look beneath the surface. Parallel planning, if actually implemented and survived coalition politics, cuts 6 years to 2. Theoretically, maybe. The housing shortage still persists through 2027 at minimum. It likely extends well beyond because reforms take time. The debt load takes decades to unwind. Your current political term? 4 years. The political timeline and financial timeline have decoupled completely. Reform announcements signal intent and feel good, but structural change requires patience the system cannot afford. A generation gets aged out while you wait for permits. That's not patience. That's erasure. And erasure compounds over time. The rental market bears the real pressure in real time because free sector rents climbed 5 to 7% in 2026. That's income growth eating itself year by year. Rent growth caps sit at 6.1% for mid-range units and 4.1% for social housing. Those caps constrain only part of the market. Affordability thresholds remain unmoved. Roughly 85% of social housing still goes to households earning under €51,500 annually. So what happens in the margins? Portfolio investors sell. Owner-occupiers buy those properties. The rental stock shrinks. Homogenization accelerates. You find yourself in the bottom of the market if you're a young renter or low-income household. You get squeezed from both sides. Prices rise while supply falls. You face rent rising 5 to 7% annually while your wages lag. The squeeze is not cyclical. It's becoming structural, hardening into permanence. Structural squeezes don't loosen. They tighten until something breaks. Households with average gross income around €70,000 will borrow approximately €6,000 more in 2026. Income growth gets translated immediately to borrowing power. This feels like progress until you realise what it enables at the margins. The European Central Bank holds deposit rates at roughly 2%. Mortgage rates have stabilised. Leverage remains accessible to anyone who qualifies. But accessible leverage doesn't solve scarcity, it deepens it relentlessly. More buyers can bid higher because they can borrow more. Prices respond by climbing. Debt-to-income ratios rise. The machine grinds higher. Somewhere in that grinding, a younger generation finds itself outside the system altogether. They're locked out not by their failure, but by the machine's success. That's the design's cruelest feature. It works perfectly. which means it excludes more efficiently each year. Wages are forecast to grow roughly 4.1% in 2026. That's meaningful on paper if you don't look at what's actually happening. Prices are up roughly 4% in forecast. This should suggest equilibrium, except prices are just prices. The debt load attached to those prices compounds continuously and relentlessly. A household that locked in a €400,000 mortgage at 3% 5 years ago carries higher real debt burden today. Nominal wages suggest they shouldn't. The spiral isn't dramatic or sudden, it's slow, it's relentless. Wages lag asset values. Younger entrants fall further behind with each market cycle. The system normalizes this as inevitable, as just how markets work. But it isn't inevitable, it's constructed, which means someone built it and someone maintains it, and someone could dismantle it if the political will existed. The Netherlands stands apart in Europe for a reason. Highest social housing percentage, most aggressive mortgage interest deduction, specific regional rent regulations that exist nowhere else. This is not contradiction, it's design layering by intent. The country built a system that subsidizes ownership while constraining supply and regulating rent. Each policy choice locked the others in place permanently. You cannot unwind mortgage incentives without destabilizing balance sheets holding those mortgages. You cannot relax zoning without threatening environmental commitments or affordability thresholds. Other coalition partners depend on those thresholds for political survival. You cannot deregulate rents without creating conflict among coalition partners. They value that protection. Your country's housing system is locked at every joint. It's cemented by decades of policy layering. Locked systems don't yield easily. They don't yield at all until something breaks, and sometimes not, even then. If your country wanted to solve this problem, the math is unforgiving and leaves no good options. Households currently carry 94% of GDP in mortgage debt. Prices would need to drop 20 to 30% to restore affordability for median buyers, for the younger generation to enter the market without financial stress. But here's what that means in practice. A household that locked in a €400,000 mortgage at 3% 5 years ago would see that mortgage worth roughly €480,000 in real terms if prices fell 20%. Their equity vaporizes in an instant. They don't walk away quietly. They default. They double down. They fight for their balance sheet. That's systemic risk bleeding into the entire financial system. That's why prices won't fall 20%. They won't fall at all. Supply will grow slowly. Affordability will worsen. Managed decline is still decline. For now, the machine keeps turning. You walk past that Amsterdam apartment again. Still €650,000. Still sold. The buyer has committed to a 30-year mortgage. 3 decades of lock-in where tax deductions reduce the burden annually. Capital appreciation justifies the leverage baked into every payment. Your country's design is patient in the way that matters. Mortgage-backed systems are patient, and patience, at scale across a population, is force. No individual can resist it. The system doesn't need prices to fall. It needs them to not fall. It needs buyers to keep showing up every quarter. It needs wages to keep growing, even slowly, even if slower than debt compounds. It needs the regulatory walls to stay in place. It needs you to believe there's no alternative to this structure. For the moment, the system gets what it needs. Pressure builds quietly. Patience compounds underneath. In the Netherlands, housing is a system, not an accident or a market. Picture that apartment listing again. €650,000. Average household income $52,000. No, that gap was designed. It persists because the design works perfectly through leverage, constraint, and tax architecture, layered over decades. Each piece reinforces the others. Each prevents the others from adjusting. You cannot lower prices without breaking balance sheets. They carry mortgages at unsustainable values. You cannot expand supply without relaxing constraints the system values, for environmental or political reasons. You cannot reduce leverage without destabilizing demand. That demand keeps those prices high. The machine was built to keep prices aloft. Machines don't reverse on their own. They churn quietly and relentlessly until the pressure builds enough to break something. And even then, sometimes the system just rebuilds itself. In a new form, more resilient than before, having learned from its near miss.